Imagine this. The next market crash happens, and while most people panic and lose everything, you walk away with even more wealth than you had before it started. Crazy, right? But what if I told you there's a simple strategy to make that possible? This isn't about luck or timing the market perfectly. It's about compounding, but not in the way you think. Stick around because I'm about to show you how to prepare for a market crash so that instead of losing, you end up gaining. Now, before you click away thinking this sounds too good to be true, let me ask you, how many times have you heard that investing for the long term is the key to success? Everyone says, just hold on and ride the waves, but no one really talks about how to prepare for the wave when it crashes. Most people only talk about the ups, but the downs, that's where the real opportunity lies. Most financial advice you hear is centered around the same old mantra: buy and hold, invest for the long term, and you'll be fine. But what they never mention is how to prepare for the inevitable market crashes, the ones that send everyone into panic mode. The truth is, crashes are not anomalies. They happen more frequently than we're led to believe. In fact, they're actually a part of the market cycle, as predictable as the seasons. You've probably heard of a market correction when the market drops by 10%. Then there are bear markets where prices fall by more than 20%. And of course, the occasional market collapse where things can drop 30% or more and happen in a blink of an eye. Crashes are as natural as bull markets, but most people don't plan for them. The problem arises when they happen. Suddenly, everyone is caught off guard. When the market starts to dip, they panic and sell their stocks at the worst possible moment, locking in their losses. So many investors do exactly this because they don't understand how compounding interacts with crashes. Compounding can either make you or break you during a downturn. Most people miss the opportunity because they don't know how to harness it properly. What if I told you that with the right strategy, those market dips could actually boost your wealth in the long run? Stick with me because this isn't just about weathering the storm, it's about using that storm to your advantage. Let me explain why most people get it wrong when they sell during a market crash. The real secret lies in understanding the asymmetry of losses, a concept almost nobody talks about. Here's how it works. Imagine you invest $10,000 and the market goes up 10% in the first year. Now you've got $11,000. In year two, the market goes up another 10%, and now you have $12,100. Your money is growing just as you expected. But here's the catch. If the market crashes in year three and drops 40%, you're not sitting at $13,310 anymore. You're at $7,260. You've lost not only all of your gains from the first 2 years, but you've also lost a portion of your original $10,000. And to get back to where you started, $12,100, you don't need a 40% recovery, you need a 67% gain. This is the painful truth about market crashes. Losses hurt more than gains help. And when people panic sell during a crash, they lock in those losses, never giving themselves the chance to recover. They're caught in a vicious cycle where the recovery seems like an impossible task. This isn't just theory, this is real actionable information. The difference between people who recover from crashes and those who don't boils down to this simple truth. The longer you wait to re-enter the market after a crash, the harder it becomes to get back to where you were. The market isn't designed to punish long-term investors, but it will punish those who make emotional decisions during downturns. Now let's get practical. There are 3 key steps you can take right now to set yourself up for success before the crash even hits. And trust me, the earlier you act, the more you'll benefit when the market dips. First, protect your foundation. This is a simple but crucial step. Create a financial cushion that you can rely on when times get tough. I'm talking about an emergency fund, but not just any emergency fund. You need 3 to 6 months of your full living expenses set aside in a high-yield savings account. This isn't for luxury spending, it's for life's surprises, a job loss, medical bills, car repairs. During a market crash, People who don't have this cushion are forced to sell their investments at the worst possible time to cover urgent expenses. Don't let that happen to you. Think about it. When your portfolio drops 30% and you lose your job, do you want to sell at a loss because you don't have cash on hand? Or do you want to weather the storm and allow your investments to recover over time? The emergency fund provides that peace of mind. It's your safety net. Second, set up dollar cost averaging and automate it. This is where your strategy for the crash comes into play. Dollar cost averaging means you invest a fixed amount of money on a regular schedule, no matter what the market is doing. Whether the market is up or down, you keep investing consistently. Why does this matter? When the market drops, your fixed amount buys you more shares at a lower price, and when it goes up, you buy fewer shares at a higher price. Over time, you lower your average cost per share, and during a crash, you can take advantage of those discounted prices automatically. It's this consistency that makes all the difference. Without it, you risk being too emotionally influenced by the ups and downs of the market, leading to bad investment decisions. Finally, diversify your portfolio. It's not enough to own a bunch of tech stocks and think you're covered. You need to spread your investments across different asset classes, sectors, and geographies. When one part of your portfolio takes a hit, the others can cushion the blow. A balanced portfolio might include a mix of stocks, bonds, real estate, and international investments. And here's why this is crucial. During a crash, diversification allows you to rebalance your portfolio, selling a bit of what's done well and buying more of what's dropped, forcing you to buy low and sell high. Now, let's talk about the numbers, because when it comes to investing, the data doesn't lie. The most important thing you need to understand is that market crashes don't destroy your wealth. They create opportunities for the prepared investor. But if you're not ready, if you panic sell or miss out on key recovery days, you're leaving money on the table. Let's take a look at some real-life data to back this up. A study by Fidelity found that if you invested $10,000 in the S&P 500 index fund from January 1980 to the end of 2022, your investment would have grown to over $1.82 million. But here's the kicker. If you missed just the 5 best trading days over that entire 42-year period, you'd walk away with only about $671,000. That's right. 5 days out of more than 10,000 trading days, and you lose nearly $1.2 million. But what's even more mind-blowing is that many of those best trading days occurred during or immediately after market crashes. During the 2008 financial crisis, for example, 7 of the 10 best single-day returns in S&P 500 history took place. If you sold during the crash to protect yourself, you missed those recovery days, and that's where you lost out. The message here is clear. Missing recovery days is far more damaging to your long-term wealth than enduring the volatility of the crash itself. It's during the toughest times that the market tends to bounce back the hardest, and if you're out of the game, you miss that bounce. So let's wrap this all up. The truth is, market crashes are not rare events. They are a completely normal part of investing. In fact, the market corrects every 1 to 2 years, goes into bear markets every 4 to 5 years, and every decade or so, we get a full-blown market collapse. If you've been investing long enough, you'll live through all of them. That's just the nature of the game. But here's the key takeaway. Compounding is the most powerful tool in investing, and it works best when you let it do its thing, uninterrupted. The asymmetry of losses means that the pain of a loss can set you back years, but the opportunity to make money in a recovery can be exponentially greater. The worst thing you can do during a crash is interrupt your compounding by panic selling. That's why right now you need to act. Build your emergency fund so that you're never forced to sell at the bottom. Set up a system of dollar cost averaging to keep you investing automatically. Diversify your portfolio to protect yourself from sector-specific crashes. And most importantly, write down your plan and commit to it. When the market dips and your emotions start to run high, that plan is going to be your lifeline. Remember,
The people who come out on top after a crash aren't luckier or smarter than everyone else. They're simply prepared. And now you're ready too. You've learned the strategies, you've seen the data, and you understand how to protect your wealth during a market crash. If you want to dive deeper into building a diversified portfolio or learn exactly where and how to invest for the long term, check out my next video. And make sure to subscribe so you don't miss out on more actionable advice. Just a reminder, I'm not a financial advisor, and this video is for educational purposes only. Your results will depend on your own decisions and actions, but with the right strategy, the market crashes ahead might just be the best thing that ever happens to you.